Okay, before we jump into this week's weekly outlook, and it's a good one, last reminder for the hat sales. As you can see here, we've sold 119, so we have a total donation of 7,140 US to Pathstone Mental Health. I'd like to get another 81 done. The last day for sales, as you can see here, is December 15th. So we have all the way to Thursday to get that done. If we get to 200, then I just bump this all the way up to 25,000 Canadian. So make me spend some money. If we can get another 81 hats done before December 15th, if we get our target to 200, yeah, I'll be writing out a big check. And then on Friday, this is the Thursday is the 15th. On Friday, they all get packed into their little boxes with their shipping tags on them, and they get brought to the shippers, and then you should be getting them the week after, well before Christmas. So if you were holding back, waiting to pick one up, and you do want to pick one up, let's get it done before the 15th. All right, let's head on in. Okay, a lot of interesting things this week, and if you watch through the whole thing, I will go through a curve steepener. I will show you how to set your legs, where to find the data, such that you can create a curve steepener, and there are structured products already based on CME futures contracts that can help you get that done. So, let's begin here. In a short part of the curve. Rather interesting. Last week, I made a point about the 1 month T-bill having dropped 25 basis points on hotter than expected PPI, and that was on the back of hotter than expected wage inflation, which seemed rather odd. Well, here we are with another 10-point drop, and we are 3 days away from the next FOMC meeting, where we're fully expecting 50 basis points. We're not expecting zero. Nobody is expecting zero, so why this is going on, I'm not really sure, but now it's spilling over into the 2 month. The 2 month is down to 413. So we're going to stick with this for a second, because I'm going to offer some explanations. Because whenever I see something like that going on, I think, well, what could cause that? And I come up with a list of questions. And then I try to eliminate those questions by looking at some evidence. Could it be, first of all, let's set the right rate, or what if the market were efficient, what rate would we expect to see? So I looked at the New York Fed's effective funds rate from December 1st to December 7th. It's 3.83. It was 3.83 every day. The range is 3.75 to 4, so it's within that range. That seems rational and correct to me. These are all constant maturity yields in the table up here. So let's calculate a constant maturity 30-day, and since this is as of the closing of Friday, we know we're going to have 7 days, and I'm using the effective funds rate here. If the market were efficient, what would it price the 1 month at? 7 days using the effective federal funds rate, 3.83, and then you'll have 23 days of 4.33, because we are expecting a 50 basis point hike. Divide that by 30, which is the average rate, we should be at 4.21, 40 basis points higher. That's not a market rounding error. I mean, if it were off by 4 basis points, I'd say, wow, if the market was open 5 minutes longer, maybe there would have been enough trading in it to get it to to move it 2, 3, 4 basis points. But 40 basis points, something's going on here. So let's look at the 60, because the 60 seems odd. We have 7 days of 3.83, 48 days of 4.33. Then you have a Fed meeting on February 1st. The expectation here is for 25 basis points, so it'll be 5 days at 4.58 divided by 60. Should be 4.29, which is 16 basis points higher than where it is right now. And then the constant maturity 90-day, again, assuming an efficient market, should be at 4.39. It's 4.31. So it seems it's really, you're getting more efficient as you move out, but there's something going on with the 1 month and the 2 month. So could it be that because volatility is expected to drop, that more institutions that were using the reverse repo are now going into the money market to get yield. The effective federal funds rate is 3.83, so if a 1 month was 3.9, why not grab that? Could be some thinking in that respect, which doesn't still make a lot of sense. So I said, well, let's find out what's going on with the Fed reverse repo. On December 2nd, and this is reported by the New York Fed, on December 2nd, it had an uptake of 2.09 trillion. December 9th, it had an uptake of 2.1467 trillion for an extra 53 billion. So it went up by 53 billion. Had it gone down by 53, I said, well, that money would have been squeezed in here. And that is just the structure of the market. It's not really anything to do with anything else. But the reverse repo went up. Didn't go down, and it cleared at 3.8%, which is 1 day SOFR. So over to the balance sheet. The Fed balance sheet dropped by 1.926 billion. These were all T-bills. So the Fed balance sheet sits at 8.074 versus 8.076. On the 1st and the 2nd, you had 22.26 billion of T-bills maturing. 1.926 were allowed to run off, which means 20.355 billion rolled over. Could that be what's going on here? So I looked at where it rolled over, and it was like 1.3 billion rolled over into January for the 1 month. You had another 2-point-something billion in the 2 month. It was basically laddered across the maturities. So it wasn't enough to push the 1 month or the 2 month. What's going on? It seems like money is moving to cash. It seems like just a whole bunch of money is getting into cash for safety, and the yield seems to be unimportant. That's the only reason I can explain such a massive inefficiency of 40 basis points. It's not the reverse repo facility. It's not the Fed rolling over, and it's an inefficient price, which means there must be some demand for the 1 month that is unconcerned with a market efficient yield. Some money has to get into cash. Unless somebody else can explain to me why that is moving in the wrong direction, why that big inefficiency, the only thing I can think is there is some large enough institutions out there that say we need safety in either the next 30 or the 60 days. Maybe they want to get out of the way of the Fed in 3 days and CPI in 2 days, given what they've seen with labor costs and PPI, that maybe they just want to get the hell out of the way. And after, if PPI comes in soft and I see the 30-day increase dramatically, I have my answer. But all I can do is come up with a list of questions and then look for evidence to eliminate the answers to those questions. It's not the reverse repo. It's not the Fed turning over. So it must be something that I don't have evidence for, which is just a whole bunch of institutions positioning in cash ahead of the FOMC and ahead of CPI. By the way, these are 2 big bad days coming up. I don't think you're going to get anything happening till 8:30 on Tuesday when CPI comes out. And if CPI comes in kind of as expected, I still don't know that you're going to get much until FOMC is over, because it's a big day for the FOMC. You got the decision plus the summary of economic projections. So you're going to get new projections, you're going to get a new dot plot, and then you have the press conference, which always seems to change things depending on what's being said. Your choices for CPI are hot or not. If it comes in hot, Tuesday could get ugly. If it comes in hot and the Fed decides to go 75 and starts talking tough, forget that Santa Claus rally. You're not going to see a 4 handle on the SPX till well into next year. But if it comes in soft, you will get a rally that day. And if the Fed does go 50 and signals that they're near the end, I don't know what could stop a rally into the end of the year. Faced with those 2 extremes, we could rally into the end of the year, or we could sell off hard into the end of the year, depending on what happens on those 2 days. That kind of makes sense for some large institutions to say, you know what? The equity markets have had a good run. let's pair off our positions a little bit, and being that we don't know what is going on, let's just move some of this stuff into cash and get whatever yield we can as a 30-day placeholder. What does it matter? Maybe that's what's going on. If we look at our capital market rates, almost no movement week over week. The 30 years basically flat, but these are small moves altogether. The 10-year increased by 6 basis points to 357. We have another story down here. Our 2s to 10s, negative 76. Didn't really change much, negative 77, negative 76. That's not much. 158 days of inversion now. I'm going to show you how to do a curve trade on the 2s and 10s. There is a curve trade on the 1030 that sometimes is considered safer simply because it's less volatile. So this is negative 76, but in the 80s this was over negative 200. Whereas the 10s to 30s, it does invert and it does steepen, but by less. So that, if you're just getting some training wheels on steepeners, the 2s and 10s is, where the big guys in the gym hang out, and the 10s and 30s are, the part of the gym where the new guys hang out, so you might want to be there. And the 3-month to 10-year, and I've got something interesting to show you here from the New York Fed. They have a nice chart up. They built a model looking at the previous inversions of the 3-month 10-year and the probability of recession 12 months out by looking at empirical data, meaning looking at the historical record and saying, well, what was, at different inversions, what was the probability of the recession over the next 12 months, because they could see where the recession was. So all you have to do is just move your mouse along one curve and you can see the probability show up on the bottom curve. So I'll show you that in a second. 46 days inverted now. What I wish they would have done for this one here is the probability of recession is tied directly to the level of inversion, but not the length of inversion. So that, let's say that you had an inversion of 50 basis points and it went flat for a month. The model they have would show no increase in the probability of recession the longer the curve was inverted. But we know that to be true, that the longer the inversion, the higher the probability. So it is just related to the depth of the inversion, but not the length of the inversion. So whatever probability we see as we're inverted longer and longer, we can increment up from that probability. So let's go look at that, and let's keep in mind we have this curious problem going on the 1 month and 2 month, and if it is a signal of money moving into cash, that would probably be the best explanation I can find, given that you have this going on. The only way we can get an answer is to see the outcome of this and see what happens here. Okay, this link is in the description box. The yield curve is a leading indicator. There's an overview which describes what it's doing, the charts, and then a whole bunch of questions. If you have questions, you can go through that, and maybe some of the frequently asked questions are your questions. So the top is the 10-year bond rate minus the 3-month T-bill. So it's the 3-month 10-year part of the curve. And anything below 0 down here is an inversion. So as you move your mouse across here, you can look at the lower panel. It says probability of U.S. recession 12 months ahead of term spread readings. So we see August 64. We have an upward sloping curve between the 3-month and the 10-year of 61 basis points. We look down, probability of recession over the next year, 17.9%. Let's get to some of these inversions. Let's see how deep they are. There's 51. And we look down, there's a 41.71% probability of recession over the next 12 months. We know we're inverted 74, so let's try to get as close to 74 as we can. Let's find one that's close to 74. Where we have to go back here to get there. I think I found one somewhere here. 86. If we look down, we see that's a 50.4% probability. 64 is a 45%. So we're somewhere between, because we're 0.74, we're somewhere between 0.64 and 0.86. So we can go halfway between 45 and 50. We're about a 47, 48% probability of recession. I can't find one that has the right number, but you can play with this and see what you can get. Yeah, that only gets to 0.49. But I thought you might find that interesting if you wanted to see what empirically. There's a 0.7. There's negative 0.7. We're negative 0.74. Look at that probability, 46.32. So based on their model, using empirical data, all the way back from, you can see in the top corner, January 1st, 1959 to November 1st, 2023, they're putting, so at December 2000, that curve was inverted by 70 basis points, and they put it at 46.32% probability of recession. I don't know how they built the model, what their lags for the model are, because as I look down and I see that 46.32, notice the upper panel, that's December 2000. And the lower panel is December 2001. It's 1 year later. They have the probability at 46.32 while they're in a recession. Wouldn't that be 100%? See, that would be my question. Is like, wouldn't it be 100%? But then again, the model probably is unaware of what 1 year out looks like. It's probably just looking at December 2000, and based on the likelihood of a recession 12 months based on empirical data from the past, they put it at 46.32. So you're almost at even odds for a recession. I think Bloomberg still has it at 100. Most places have it at even odds of a recession. Somebody had pointed out last week that Goldman was saying there was 35% probability of recession. In reading it, it read more like there is a 35% probability of avoiding a recession, not of a 35% probability of a recession. So maybe I'm not reading the same thing that the other person was reading, but I read it as a 35% probability of avoiding a recession. It was written in the negative, in the positive, if you can follow that. Anyways, if you want to play around with this and maybe go to some of the frequently asked questions, because there's a whole bunch of interesting questions. I didn't go through these questions, but you can. Let's look at the market implied probability for the rate hike on Wednesday, 50 basis points, 78.2%, 75, 21.8, and that is primarily due to that big unknown Tuesday morning at 8:30, unchanged from the week before, because your risk events are unchanged, so why would the probabilities be unchanged? I think those probabilities are reflecting that big unknown on Tuesday. For February, this gets interesting here. Based on where we are now, for February, after the FOMC meeting being 75 basis points higher, it's a combination of a 50 from December and a 25 from February, has a weighting of 40.6, down from 46.1, but look at the 100, 48.9, up from 44.9, and the 125 is 10.5, up from 8.9. You get 125 by saying, well, 75 December, 50 in February, which is pretty aggressive. But the probability has increased on these and decreased on a 50 and a 25. That's going to be interesting to watch on Tuesday morning at 8:30. CPI hot or not, what is going to happen to those probabilities? Weights are either going to move all the way to the heavier end, or weights are going to move all the way to the lower end. That's a big number we're looking for. The term structure of the Fed funds futures, it bottoms out May, June, July, 95.045, 95.04, 95.05. They're, other than rounding, they're basically the same number, implying a rate 4.95 to 4.96, call it 4.955. Last week, it was May and June. It bottomed out in May and June at 95.085, implying a rate of 4.915. So we can see that it has increased, but not a lot. There's still a belief that we're going to be somewhere between 4.75 on the low end to 5.25 on the high end. And that the hot inflation data isn't going to really matter too much, because they have said that, listen, we need to let all these cumulative rate hikes take an effect. There just hasn't been enough time for it to take effect. So I think the market is thinking that they're going to use time from here on in, that the big rate hikes are done, but the rate hikes aren't done, but the big ones are done. And to not move that much sort of suggests that the market just isn't feeling that anything above 5.25 is going to make a lot of sense. Well, Wednesday we get the new dot plot. We'll see what they think. Right, we get 19 dots on that dot plot. And Tuesday morning this curve is going to move, and Wednesday this curve is going to move. There's a lot of volatility that's going to happen in these futures contracts all the way till Wednesday. So I don't know that I would be too willing to take any positions ahead of Wednesday. Last week I said that going along the December Fed funds futures makes sense. I still believe that makes sense, but I think the optimal entry point would be after these two big risk events when you have a lot more clarity. For December, we have an implied rate based on the pricing of 95,405, an implied rate of 4.595. Last week it was 4.495, so it is 10 basis points higher, but still 36 basis points lower than the peak rates here, implying somewhere between a 25 and a 50 basis point cut by the end of the year. This is the January contract price. This is the February contract price. You see that big steep drop? That's 36 basis points difference. And that is reflecting the fight between, is it going to be 25 in February or is it going to be 50 in February? Because 36 is in between the 25 and the 50, so there's some equal probability that seems to be placed on, well, it could be 25, could be 50. All that can change the second after 8:30. Real yields all have returned. Remember last week we had a huge drop in real yields. Here were your real yields last week, and now they're moving back up. Inflation expectations moving down because, as we saw on the first screen, nominal rates moved up just a little bit. Real yields really moved up, which pushed inflation break-evens lower. This will be interesting on, this will be more affected by CPI on Tuesday morning, that these are very low break-even rates. So if CPI comes in hot, these break-even rates are far too low. So are you going to get a sell-off in nominal yields to move into tips, which would lower the real yield over here, but raise the nominal yield until the market feels it's the proper break-even? I don't know. On the one hand, if we have very light inflation, I don't think anybody is forecasting a high growth regime next year. I think they're all forecasting a low growth regime. So you combine a low growth regime with falling inflation, you're going to have inflation expectations and low growth being reflected in the long end of the curve. I think rates would drop at the long end of the curve. Bond prices would rally, which means you'd want some duration exposure. The short end of the curve will reflect a 50 basis point increase, and you could invert even more based on a benign inflation reading. And if you do invert even more, there's the time to start thinking about a curve steepener. Wait till after that report is out of the way. The other side of it is the side that I really don't know what to expect. If inflation comes in very hot, is the market going to put inflation expectations back into the long end of the curve and yields will rise, meaning bond prices will drop? Or will the market start saying, okay, recession's a done deal at this point. Inflation is so hot, the Fed is going to raise rates to the point where it will break the market. There's just no other way. We're going into recession. And will the long end of the curve reflect recession and yields start dropping, meaning prices are increasing because the longer end is going to reflect a much lower growth environment than just low growth from a soft landing? That I don't know how the market is going to move on that one. If it comes in light, I pretty much know, not know, but I'm pretty confident of what the outcome would be. But if it comes in hot, which argument is going to win? Inflation expectations coming back into the long end of the curve and the long end moving up, yields going up, or a recession becoming even more of a reality in investors' minds and the long end of the curve moving down? This one here, I just don't know. Okay, corporate spreads, OAS, nothing interesting here at all. Nothing has really moved that much. If we look at issuance, kind of interesting here. Here is the issuance for November. This is from SIFMA. Month over month for investment grade, October was 87.6 billion in issuance. November increased to 103.5 billion. High yield went from 3.2 to 10.4 billion. So November is showing an increase in issuance of corporate debt. For year to date, 1.3524 trillion has been issued. That is down 12.7% year over year. So because you have fewer bonds being issued, and of course over the year, you've had some retirement of corporate debt as well. That could explain why spreads are rather tight, is because you do have credit funds out there whose job is to buy these bonds. And if there are fewer and fewer bonds to buy, well, you have to accept lower and lower yields to get it done. Trading has increased. Average daily volume is up 2.2% year over year. Yeah, I don't know that I'd get too excited about 2%. Total corporate debt outstanding, 10.3 trillion. Up here we have consumer credit. This was released December 7th at 3 p.m. It's released by the Fed. This is the total outstanding now, 4.7 trillion. So 10.3 trillion in corporate debt. You got 4.7 trillion in consumer credit. This is non-housing related. So mortgages are a different thing altogether. To get that information, we get that quarterly, and we get that by the New York Fed. The increase in consumer credit on an annual basis is 6.9%. That is for the course of over the year. If you look at the numbers month, by month, that is rather low. So revolving increased by 10.4% on an annual basis. Non-revolving by 5.8%. Revolving are your credit cards, lines of credit, things like that. Non-revolving are your auto loans and things like that. Total flow 324. How you get that is, here's the month over month, is you just take the change in revolving and non-revolving, or just take the change in total outstanding, which is some 27 billion, multiplied by 12 to get the total flow at an annual rate. So we can see that credit card usage increasing on an annual rate in October over September by 10.4%. It is dated, it is October, but it is information we don't have from the New York Fed when we look at the consumer credit reports from New York Fed, which shows the total amount outstanding for Q3, which ended September. So we are getting sort of a first look at the next quarter with October's look. Mortgage rates dropped again, another 16 basis points, down to 6.33%. Mortgage rates are dropping, fully knowing that we have a 50 basis point increase coming, because they are going to be related to the 10-year. So there is another implication for Tuesday's CPI. What's going to happen to the 10-year nominal yield? What will happen there will happen here. I don't know if the Fed is too happy seeing mortgage rates come down. The high was 7.08. We're at 6.33 on a 30-year, 5.67 on a 15-year. Mortgage applications were down for the week ending December 2nd, 1.9%. Refinances up 4.7. Purchase index down 3.03. I've looked at all of the housing stocks quarter to date. And looked at the target price changes over the last 30 days for each of them, because housing has just been on an absolute tear the last little while, and I've had exposure to quite a few of these names. And I'm thinking about selling calls on 50% of my position on Monday ahead of CPI, because if CPI comes in hot, these mortgage rates are going back up. If they're going back up, a lot of this rally can come out of the housing stocks. Some of this rally has been due to that 30-year fixed rate mortgage coming in, and the spread between the 10-year and MBS coming in as well. We saw that showing up in the mortgage REIT rallies. But look at some of these housing stocks. This is quarter to date. In other words, October 1st to now, DHI is up 27.08%. Toll Brothers up 16.51. Good earnings on Toll Brothers. Pulte up 17.87%. KB Homes up 20.43%. Lennar up 20 earnings this week on Lennar. Look at the price changes here. BTIG 101 up from 90. JP Morgan 100 up from 81. KeyBank 97 up from 84. Significant upgrades to DHI. DHI is forecasting $8 to $9 in earnings well, hang on, was it DHI that did that? No, sorry, it's not DHI. Sorry, Toll Brothers was forecasting $8 to $9 in earnings next year. 8 to 9, and they're sitting at 48. So they're just a little over 5 times earnings, right? Look at Toll Brothers. UBS 65 from 61. Barclays is 50 from 47. RBC, not too impressed. 49 from 48. Why even bother? Like, why even bother changing it? It's like, it'll be $1 higher in a year. Come on. Pulte 61 from 50. KeyBank 51 from 47. KB Homes, JP Morgan at 36. They were at 32. And Lennar 101 from 92 for BTIG. JP Morgan 97 from 73. KBank 100 from 89. This is just in the last 30 days. The home builders have been are being upgraded in terms of their target price, and they've had excellent performance. Excellent performance because the conditions are right for the home builders in terms of the environment that they're operating in. Never mind the financing environment, but in terms of the balance between supply and demand, even though demand is down, all of them have order backlogs on their books in the billions. The billions. Housing prices really haven't come in that much considering how much the mortgage market has fallen apart. But, you know, you get some fear in the 30-year fixed mortgage. You get that heading back up to the 7.08. Some of these gains are going to come out. And some of these gains, like, 27% since, quarter to date. That's been a good run. I've had a good run on some of these, and I don't want to get out of them. But at the same time, I can't sit in front of this big number and say, well, what's going to happen here? So I think I'm going to sell 50% of my position with calls. I'm going to sell calls on 50%, and I'm going to use a delta of 0.6, which is slightly in the money. If they get called away, well, okay, then half my position will be called away, but I'll still have some upside. If they don't get called away, well, at least I protected my position, and I still think that what caused these to rally, not just the low rate, but the fundamentals of the market that they operate in. Over the last, you have these long business cycles, right? And it's these over here that really make you, if you're in the right sectors. This is 2010 most recently, right, the beginning of 2022. REITs outperformed the S&P over that whole period by a significant enough amount that it was better to be in REITs than in nothing else, and I was heavily focused on REITs. In this period here, I'm going to move, I think this is going to be dominated by mining stocks. I think it's going to be dominated by the home builders in the U.S. and probably this early part here, REITs in this early part, but I would be probably looking to exit REITs here. Mining and housing, I think, in this next cycle are going to be the big winners. Maybe energy, but I'm not an energy person. I don't spend a lot of time with the energy stuff. I've tended to avoid it for the most part because I don't really want to dive deep into that whole industry. Whereas these, I already understand them quite a bit. But the next cycle up, I think these are the big winners, and I'm already positioned with the XHB as well, the Home Builders Index. I will be selling calls on 100% of my position on the index on Monday to position for Tuesday. But I thought you might find that interesting because when I did mention the home builders, there was some skepticism that, well, isn't it the wrong market to get into? being that mortgage rates are going up and the mortgage market is going down. New home sales are going down. Existing home sales are going down. Why would you want to be in the home builders? When you see these kind of numbers, the market is sort of seeing that, well, hang on a second, it's the supply-demand imbalance. That's the big story. U.S. total vehicle sales for November, 14.1, came in lighter than expected. Last month was 14.9. There's October, so you can see November coming down. But still, if you look at May through November, look at this nice increase on the way up. So maybe this was an anomaly month over here. Let's look at how some of the auto makers have done quarter to date. Ford is up 18.91%. GM's up 19.55%. We'll come back to Tesla in a second. VW is up 18.23%. BMW up almost 21%. Toyota's up 10%. BYD, Warren Buffett's investment in China, up 9%. Tesla quarter to date down 32.7%. Down 32.7, and based on a forward multiple is still probably significantly overvalued. But quarter to date, I don't know that you could be a cheerleader for too long when you keep looking at that performance. Now they have lowered some prices in China. They are idling their factory in China at the end of December, and they have cut back on hours in their China plant as well. Which is in line with facing tougher competition in a world with decreasing demand as we face the reality or the very real prospect of an upcoming recession. Okay, let's have a look at TLT. Some interesting action on TLT. This is what I'm drawing out here is just the last leg. They were significantly higher than this. This is just the last peak they were at and the last low that they were at. So this drop, this rally we had here and where the closing price is a 50% retracement from the top of this to the bottom here. We do have a double bottom over here and a 50% retracement. We had a pullback on Friday. We got over 110. That was pretty exciting. You did have a pullback at the end of the week. 103 seems to be near-term support. I would be looking to add puts on pullbacks down to 103 because I do have the January 2024 115 calls at 650. I did take 10% of my position off last week because that is just too big of a move in front of what is a big risk event this week. Two big risk events, CPI and the Fed. It was just too exciting of a move. So I took not a lot. I don't want to lower that position too much, but I took 10% off at a profit. We did have a pullback. I could have added a little more, but I thought, no, I'm not going to do anything now till after I have confirmation of what's going on with inflation and the Fed. And if we do get a continued rally, well then, good. 90% of my position is still in play. It's not a full position. I didn't put a full position on, so it's not as much as I would like, but based on what I see on this week, I may add to this position. Even as we're rallying, I may add to the position. But if we do get a sell-off, it'll be a great opportunity to re-add this 10%, plus probably double the position on the calls. Maybe I can get them less than 650. But volatility will hopefully increase on any sell-off on TLT, and I can probably go to the 95s or the 92.50s and sell some puts over here to start paying for these calls. We'll see what happens. So I have a scenario here, inflation coming down, inflation going up. If inflation comes down, my thinking is inflation expectations will come out of the long bond, so I'd want to add duration at that point, which is a long position in TLT. If inflation comes in higher than expected, probably higher rates initially, you will get a sell-off. But I think you'll get a deeper inversion of the curve, pushing the probability of recession higher, and rates will be cut as the recession occurs and the recession deepens. So going out to, looking out all the way to January 2024, I think we'll be well within a recession, and the Fed would have cut rates by then, increased duration. So when I do this and I think it through and I come to the same conclusion, no matter which way I go, that's when I know that I have a trade. And that's when I feel a higher level of conviction on that trade, when I can see that a long duration trade makes sense in both ways, in both conditions. So it's not a binary event anymore. There's some probability greater than 50%, I think, that this would happen if inflation were low. And there's some probability greater than 50%, I think, that this would happen if inflation were high. Well, I'm playing the odds. It's a numbers game, so long duration. If I'm wrong and there is not a rally, I will sell puts down here, and if it keeps dropping, I'll sell puts at lower and lower to pay for the calls that I put out. I did already take 10% off. I'll fully pay for the calls so that I'm cash neutral. And if these are put to me, well, at some point we're going to get ugly enough that we will hit a recession. So good. I'm long at a lower price, or I'm long at a higher price. I feel very good about this TLT trade by January 2024. That's a destination, right? There's still a pathway to get there. The path is not going to be straight up. It could be like this. Oh, it sells off a lot and then it starts to rally again. But I'm betting on the destination. The pathway will determine where I sell my puts and how many more calls I would buy. So I'll let the pathway tell me what I'll do next. But I do believe that a long duration, it makes a lot of sense, and this is the an efficient way to get it with a buy and hold that has a yield. Even if you're buying the underlying, it has a yield. If you don't like buying calls, by the way, if a 115 call for January has a delta of, let's say, 0.45, that is equivalent to buying 45 shares of TLT. And then you wait a month, and if the price goes up, you look at the delta on the 115s. If the delta has moved to 0.54, you buy 9 more shares. There. And you can replicate a call by just changing the number of shares you have by the delta of the option. And when you own the underlying, you get the dividend, and you don't have a negative carry, because buying the calls does have a negative carry. Okay, let me lead you through a curve trade, and there are products all ready to get it done. Ticker TUT, that's the 2s versus the 10, and NOB, which is the 10 versus the 30. You'll sometimes hear it called the 2s under 10s, or notes over bonds. I had had some questions last week about the curve trade versus adding duration, because part of the curve trade is you're going to be short a longer term bond and you're going to be long shorter term bonds. So the focus was on, but you said you'd go long a long term bond with TLT, but now you're saying you're going to go short a long term bond in a curve trade, which can be confusing. A curve trade is not a trade on the level of interest rates. Not at all. In fact, what you're trying to do with a curve trade is eliminate the level of interest rates so that it doesn't hurt you. So if rates go up or rates go down, you don't care. All you care about is the slope of the curve. So you're playing just the slope of the curve. So here is a descriptor of a curve trade here, which I found to be quite good. An attractive characteristic of yield curve spread trades is that performance is independent of absolute interest rate changes. As the transactions are long and short by definition, market rallies or sell-offs do not generally affect performance in the same way an outright long or short bond or futures position would be affected. So you can be long the long bond in anticipation that the yield on the 30-year, the 20-year is going to decrease, which means price will increase. That's one trade. Or you could say the curve will stop being inverted and will steepen. Well, that's another trade. You're playing just the curve. Your bet is on just the curve. So I'm going to walk you through how to set up one of these trades. And again, you can do it with TUT or NOB. But these are using the quarterly. So right now, these are the threes. This would be for the first quarter of 2023. I don't expect it to do much by that point, so I don't know that that would be an interesting trade at that point. But you can always roll them over, much because they're made up of futures contracts. So you are going to have to roll them over if you want them to last over the course of a year. So on the CME site, under Quick Strike Tools, drop that menu down, find Treasury Analytics. And in the grid that you get up, find the subheading for intercommodity and click on IC spreads and you'll get a screen up. I'll show you how to do all of that in a second. So as of the December 9th closing, here's the structure of TUT. Two contracts on the front leg, and this is your long position. So two, and this your front leg here for TUT will be ZT. The futures contract will be ZT, which is the 2-year. The back leg is the 10-year, which is ZN, and your 1 there. So you're long 2 on the front end, short 1 on the back end. Now ZT and ZN have different prices, and they have different durations. So whenever we're trying to get duration neutral, when you have different prices and different durations, we use dollar duration. But that can end up being a very big number. So if you divide that by 10,000, you get something called a basis point value, or more commonly in the US, it's called the dollar value of an O1, DV01. So that's what we need to do, is get that neutral so that we no longer care about interest rate increases or decreases. If you don't care about doing how all of this comes together, if you just buy TUT, it's already structured for you within it. But I think it's worth knowing how this is done. The hedge ratio, the exact hedge ratio is 1.884, meaning that we really should be long 1.884 ZT and short 1 ZN, but you can't get 1.884, so you go to 2. So because it's not a perfect hedge or a perfect duration neutral trade, you are going to have some tail risk. If you were doing bigger volume, you're an institution that's doing bigger volume, you would adjust your position to eliminate tail risk. Here's how you can do it. We look at the 2-year, we look at the 10-year, and in the grid that I'm about to show you, when you click on this, we are given the DV of an 01, or the basis point value of the 10-year and the 2-year. We get them duration neutral by dividing the 10-year by the 2-year. So 65.13 divided by 34.58 is 1.884. That means if the 2-year and the 10-year increased by 1 basis point, the 2-year would lose 34.58 times 1.884, but the 10-year would gain 65.13. You'd notice that those are the same dollar amount, so that increases or decreases in rates mean nothing for this trade. It is only the steepness of the curve that matters. And these DV01s, because these are futures contracts have an underlying, which is a generic bond, so there's always a cheapest to deliver that's identifying. This is based on the current cheapest to deliver. If you were an institution and you said, well, I'm going to do 100 of these, well, you get to 188.4. So what you want is 188.4 contracts of ZT versus 100 contracts of ZN. Well, you can buy 100 TUT. You'll have 200 versus 100. To get this to 188, you then add on a short position of 12 ZTs to eliminate tail risk. Now you have a perfect hedge, as perfect as you're going to get, of 188 or 1.884 to 1. If you are short TUT, you're betting on the curve flattening. Means the spread decreasing, becoming less positive. It's decreasing its positiveness or increasing its negativeness. So short means, let's say we have an inversion that looks like this. You're betting that it's going to go to this. Long means we have an inversion. You're betting that it's going to go to this, usually by the front end of the curve dropping in that respect. So you want to be long TUT or long NOB. These are curve steepening trades. If you think the curve is going to get more inverted, you can simply just short TUT or short NOB. I don't know. The 10 to 30. I don't know. I'm just not seeing much excitement there. Nor do I have a focus on the 10 to the 30. I think the 2 to the 10 is the more exciting one. But it can get more inverted. So my thinking is, if I was going to do that, I would certainly wait till after the Fed press conference, and I would see how the market is responding. And if that inversion is increasing, I would wait before I took a position in TUT to see if it would invert more. The more inverted it's going to get, the higher the probability of that recession. The longer it stays inverted, I'd start to feel more comfortable every single day that it's inverted of taking a long position in TUT, because I would think that the recession itself would cause that curve to steepen. So you may think that, well, if we have a curve that looks like this, and we think that the long end of the curve is going to come up, isn't that a curve flattener? No, that's a curve steepener. This is called a bear steepener because the long end of the curve is coming up, yields up, prices down. That's bearish. That's a bear steepener. A curve steepener is when the spread between 2 and 10 is positive and increasing, or is negative and increasing towards 0. If you have a negative spread between the 2 and the 10 and it's increasing towards 0, that is a curve steepener. Anything where the number is going up towards the positive side is a steepener. Anything where the number is going down and becoming more negative is a flattener. So hopefully that helps clear up a few things. Let me show you how you find all of this stuff on the CME site. Okay, so on the CME site, I'm already on Treasury Analytics, but if you just click down the Quick Strike tools, it's second from the bottom, Treasury Analytics, you'll get this up. And a lot of interesting things here. Here's your cheapest to deliver list. So you can look at the 2-year, your cheapest to deliver versus your on the run. So it tells you it's the 1 3/4 coupon with the maturity in 2024 for the 2-year. It gives you all of your cheapest to delivers. What you're doing is you're going down to intercommodity, and there's your IC spreads. You click on that. So you have your product, your 2-year, your 3-year, your 5-year, and you have the different symbols that you can play. There's the TUT right there. The front leg is the 2-year, the back leg is the 10-year. So that's the 2 to the 10. Knob spread is down here, a 10-year to the T-bone, which is the 30-year. And it gives you your hedge ratios, for TUT. Where are we? Right here. So we can see price ratio 4, leg ratio 2. So your front is 2 to 1. If we need to, we can keep reading across here. There's your hedge ratio, 1.884. So how do we get this hedge ratio? There's the curve, the yield spread inversion right now, -73, and we're betting that moves up to 0. So when we're long TUT, we're betting this moves up towards 0 and turns positive over time. For our hedge ratio, there's the 2-year. And we're looking for there it is right there, the DV01, futures DV01, the dollar value of an 01. And this is based on what the cheapest to deliver is, because the futures contract will adopt the characteristics of the cheapest to deliver. So it will have the duration of the cheapest to deliver and the DVO, the basis point value of the cheapest to deliver. Because the 2-year and 10-year have different prices and have different durations, you can't just use modified duration and get it done, or effective duration and get it done. You have to use dollar duration. But dollar duration ends up being a big number, which is why you bring it down to 1 basis point. So there's the 34.58. If you go to the 10-year tells you it's 65.13. It's 10s over 2, so take the 65.13 divided by 34.58. You'll get the hedge ratio of 1.884. And you could do the same thing. You can recover all of these hedge ratios from all of these dollar values here. And for NOB, it's the 10-year and the T-bond, and it tells you, there's your Treasury bond right there, it's 145.02, the 10-year is 65.13. If you divide 145.02 by 65.13, you will get 2.227. And that's how you read these. Some interesting stuff here. If you click on the 2-year, the very first thing tells you what the cheapest to deliver is. It tells you what coupon, what maturity, the futures price. It gives you the duration and the modified duration of the contract and the DV01. If you click on the 10-year, it tells you what the cheapest to deliver is. It's the 3 and 7/8 coupon, maturity on 9/30/2029. It gives you the modified duration of it. Because they have different prices, see the price here, 114.03, has a duration of 5.9043. If you click on the 2-year, notice you have 102.25 with a different duration. So you can't just take a ratio of the durations and figure that's your hedge ratio. It has to include the difference because they have a difference in price. So 1% move on one is going to be a different dollar value than a 1% move on another. That's why you have to combine price times duration. And if you multiply by 0.0001 or divided by 10,000, you will get 2 basis point value. So take this futures price, multiply it by this duration, and divide it by 10,000, and you should get the DV of an 01, which we saw on the previous screen. Lots of interesting stuff on this one, right? Okay, let's have a look at ZQ. As you can see in the top corner here, the expiration here is December 29, 2023. This is the December 2023 Fed Fund Futures contract. All contracts for a particular month expire on the last day, the last trading day of each month. So this expires on December 29th. And how this works, the contract price now is 95.405. So if we are long the 2023 Fed Fund Futures and it goes from 95.405 to 95.505, we're up 416.7 US dollars. Every 0.01 is 41.67 on the contract. The underlying is 5 million. So 1% of 5 million is 50,000. And when I say 1%, that would be going from 95.405 to 96.405, which on the contract would be $50,000 on 5 million, but you got to divide that by 12. So that whole move here from 95 to 96 would be 4167 in a gain. So December 13th is CPI. December 14th, we get a new dot plot and new summary of economic projections. The CPI will affect these. So the dot plot and the summary of economic projections will take into consideration whatever CPI is. The current rate implied by the December Fed Funds futures price is 4.595. If CPI comes in hot, I'm looking to add a long position. Even before the Fed meeting, I'm looking to add a long position somewhere in the range of 95.25 down to 95. So in this range over here, if this contract gets within this range, I am looking to add a position in the December Fed Fund futures. And that is purely not an anticipation of a Fed pivot and they're going to cut rates. That is purely a recession trade. It's a bet that the Fed will have to cut rates because the economy will tip into a recession. And the idea of are we going to get a mild, moderate, or severe recession depends on what the Fed action is if we slip into recession. So if we slip into a recession and they say inflation is high and we're holding the course, forget mild, you're going to move into moderate. And if they say, no, inflation is high, we're still holding the course, you will move into severe, the Fed will have no choice but to relent for the economy's sake. This trade is purely a recession trade. TLT is a trade based on inflation expectations coming out of the long end of the curve or a recession. And a curve steepener is basically based on a recession as well. So it's, you have to figure out, well, what is your scenario and what's a trade for it? This is a recession, basically just a recession trade. But I would be interested somewhere in the 95.25 to 95 if CPI comes in hot. If CPI does not come in hot, then I will not move before the Fed. I will listen to what the Fed has to say and then decide from there whether or not I'm still interested in the trade at this point in time, or if I want to wait for a little bit more information. Okay, let's look at DXY. There's a big risk week for DXY as well because it is going to be CPI and Fed determined. If CPI is benign and the Fed goes 50 and signals, maybe another 25 and then they'll hold, I don't see any strength for DXY. DXY has already shown some significant weakness here, and I think it would probably break the next support at 103.93. We're sitting at 104.81, which is below this very high-speed trend line on the way down. This high-speed trend line, by the way, that is unsustainable, meaning that you're not just going to get this kind of move in the DXY. There's going to be some kind of sideways move, some kind of consolidation at some point, but your next support is 103.93. CPI comes in hot, look for the DXY to rally, and resistance will most likely be at the 200-day moving average, which is 106.69, but you could see it rally back to 106.69. And again, we are still below this high-speed trend line. It did have a rally, but it did stop at the trend line and pull down. So I didn't have to change the speed of the trend line. It's still the same trend line. The miners, if CPI comes in hot, you can look for the miners to pull back. What has been supporting the miners so far is the DXY dropping. Because the commodities are priced in US dollars. So as the dollar drops, the price of the commodity goes up. And if the price of the commodity goes up, well, that works out well for the miners. A 1 month return on these. This is just over 1 month. BHP up 17.67. Rio up 22.78. Freeport 8.6. And the ETF, the iShares ETF pick up 11.24. With BHP and Rio being real winners there, being very happy about that. The home builders, the miners, I was taking positions in these because I thought they were going to be great for the next bull market. But in the last 2 months, they've returned, nice returns. I now hate myself for taking initial positions and not taking full positions. I've said this a couple of times in the last couple of years, not just a couple, but quite a few, is that the market no longer gives you time to build a position. If you have an idea, you pretty much got to take a full position right then and there, which is usually not what you would do. And if I were 21, I could probably break that habit by not having that habit and just taking full positions until it hurt me. But taking full positions in the past has hurt me. When you take a full position, what you're saying is, you have no choice but to be right. You have to be right because you've taken a full position. I hate myself. I hate myself over the last couple of years only because, I've been able to identify some winners, but I've just been hesitant in taking a full position. And here we go again. I haven't been taking a full position. On these ones here, because of the risk of the DXY, I will also be selling 50% of all of these positions using calls with a delta of about 0.6. So if we continue to rally, well, okay, we continue to rally. I'll still make money on the call, but if the DXY does show strength and these pull back, at least I'll be partially hedged off by the call. If DXY goes up, you can look for copper and gold to sell off as well. Copper has had a good run. Aluminum in the last, since mid-October, last 6 weeks or so, went from 22 to 25. What I tried to do is I tried to find the high point in the DXY just to catch this last run and then try to find the same time period in the charts. Aluminum 22 to 25, copper 332 to 385. That's a big move in copper. Gold, 1,630 to 1,796, $170 move. That's a little over 10% move in gold. Platinum, 880 to 1036. Silver, look at that, 23.4%. The LME index, October 1st to date, this is quarter to date, up 15.28. The DXY weakening has done a lot of the heavy lifting for this. A lot of the heavy lifting. You have some China story in there. Some China story. We're worried about lockdowns. And when we see that, the protests that were happening, they're easing some of the lockdown things. There's some hope that demand will come back from China. It looks like the Chinese Communist Party, I'll just call it the government instead of calling it Chinese government, but they're looking like they're willing to support the home builders there for to some extent, which is positive for materials. However, the relaxing of the zero COVID policy, because you have such population density that the infection rate is spreading rapidly. So not locking down is probably going to end up having a worse effect on their growth than locking down does, because of just the sheer spread of the infection. So I don't know if they're going to be able to hold the line on relaxing restrictions before they get to the point of saying, we can't handle this anymore, we got to completely lock down. I don't know. That's going to be interesting to see. But as of right now, this is our big risk event right here for the DXY. And anything that's a risk for the DXY is going to be a risk for the miners and a risk for commodity prices. Okay, let's look at the VIX. We are now moving towards more uncertainty, where I'm sort of 50-50, where I don't have that much clarity. I have more clarity in the fixed income space right now, based on expectations, but when it comes to equities, I just don't know. So here's our VIX. Notice we are back in the support resistance zone now. We did have some closes below the low end. The VIX was down to almost 19 at one point. Is this a false breakout, or is this just a bounce before we come back down? I don't know. I do note here that the 200-day moving average is above the 50-day moving average. So with the 50 below the 200, that is typically bearish. Bearish meaning that the chart pattern would be downward. So that means bearish for VIX, but bullish for equities. The correlation between VIX and the SPX is negative 0.68. And this is covering the whole period 1990 to 2020. It's the highest correlation, highest meaning towards 1. Whether it be towards +1 or -1, we call those high correlations. Something uncorrelated has a correlation of 0. Negative 0.68. Here are the VIX futures prices if you were going to play the VIX in any particular way. You could use futures or options. These are for 1,000 times the VIX index. If that's too big, there's a VXM, which is a mini VIX for futures, which is just 100 times the index. Now, for the futures pricing, if you are used to what's called no arbitrage pricing, most contracts, futures contracts with an underlying, are based on no arbitrage pricing, meaning that it is really just the cost of carry, that the futures price is the cost of carrying the underlying to that future date. Well, the underlying here is just an index of implied volatility. There is no underlying, so it is not a no arb price futures contract. From the CME site, this is the description of the futures price. It reflects the market's estimate of the value of the VIX on expiry dates in the future. That is not the description of, let's say, an SPX futures contract. The SPX futures contract reflects the cost of carrying the underlying to that point in time, which is a function of the risk-free rate and the dividend yield, but is not the market's expectation of what the future price of the SPX will be. However, here, the futures price on the VIX reflects the market's estimate of the value of the VIX. So if we look at January 18th, 25.2. February 15th, 25.6. They increase throughout it. It is in contango, which is typically the normal shape or the normal term structure of the VIX futures curve. It does go into backwardation whenever you have big spikes in implied volatility like here. You'd expect that curve to be in backwardation because no one expects this to continue to increase. They do expect that you're going to get a drop in volatility from those huge spikes. So huge spikes could cause backwardation, but it's typically in contango. We'll note as well with the VIX moving back into the support resistance zone, the SPX has moved back below its previous resistance level, so those resistance levels are back in play. A false breakout on the VIX was also associated with a false breakout on SPX. SPX is back within its support resistance zone. The VIX is back within its support resistance zone. You getting tired of hearing this? Everything depends on that. Everything depends on that. So if CPI is hot, that index, the VIX, is going to increase. Period. It's going to increase because that's going to be negative for equity markets. If it comes in light, I expect VIX to drop and SPX probably to go back up and test its resistance levels. Although you could make an argument that the market may be hesitant to retest resistance, upside resistance on SPX, because the Fed may come out the very next day and say, we don't like what you're doing. You know, they've done it before. They did it in August, although November 30th, Powell didn't seem to be overly concerned with talking tough and barking at the crowd. He was kind of mild in his talking. Nothing but question marks when it comes to the equity market. You know, to the point where I think, what if it comes in hot? What if it comes in light? Well, I have two different outcomes. I don't have the same outcome with higher than 50% probability on each one. I have two very different outcomes. And when you have two very different outcomes, you are making a binary bet at that place. At that point in time. And I don't like binary bets. So whenever there's a binary bet where you're betting on an event, I'd rather see the event first and miss the first part of the move and be fairly confident in the rest of the move than to try to stand in front of a move that could just destroy you in 3 seconds. Because as soon as that CPI hits at 8:30, that market's moving. That dollar is moving. Everything is simply going to move. So you better be positioned to be neutral in front of it if you don't want to get hurt either way, or you better be right. Okay, let's look at the implied volatility and the level of skew. This is the VIX January 2023 VIX versus January 2023 SPX. And it's versus 2 weeks ago on each one. Notice that they're opposite each other, right? They have a correlation of negative 0.68. So typically when we think of skew, we think of this kind of shape, while the VIX would have the opposite, because as the VIX increases, the market decreases. There's that correlation, that negative correlation. So we can see this, when we look at the volatility, this is the volatility of the volatility, or what's called the VVIX, volatility of the VIX. It has gone from 70 to almost 80%, huge volatility. 2 weeks ago versus where we ended Friday. Notice you have an absolute increase in the volatility of the volatility throughout, and you have an increase in the volatility on SPY as well. Sometimes it's helpful to see these relationships so that we can understand that a call option on VIX is equivalent to, well, 68% equivalent to a put option on SPY. So that when we're thinking in terms of moves on the volatility index, it's kind of like bonds with yield and price. Yield up, price down. When we're thinking about VIX and SPX, VIX up, SPX down. Okay, here is the culmination of it all, SPY. What are we doing for SPY? And I want you to remember last week's title, Fixed Income Certainty, Equity Uncertainty. This is still true. There are certain trades in fixed income I feel very certain about. For equity, I have nothing but a big question mark until we get past the Fed press conference. Forward 4-quarter EPS right now is sitting at 228.74. The SPX closed at 39.34.38. So here we are. Closing price on SPY that matches that is 393.28. We're at 17.5 times earnings. 18 times earnings is up here at 404.51. 17 times earnings is down here at 382.04. So on a fundamental basis, 18 times might be resistance, 17 times might be support, fundamentally speaking. Technically speaking, the 200-day moving average is sitting at 402.89. The 50-day moving average is sitting at 383.34. After hours it got to 392.55, but really we're looking at 393.28. We're $10 above the 50-day and very close to $10, $9 below the 200-day. So we're kind of right in the middle. You know, you couldn't get more unequivocal or more equivocal than that. Is like, well, you're in the middle. It's not leaning towards any one side. The recent top was 407.67. The previous top 411.18, which is back here. This is on a closing basis. Intraday it got above the 407.67, but on a closing basis. And we have a downside gap still at 381.14. So here's your sort of support to the downside, the 381 to 383 zone. And on resistance, you're somewhere between the 402 to the 407. You break above that, you could hit resistance at the next previous top, which is 411.18. And this is 429.70, or basically 4,300 on the index. Is this a scenario? Yeah, let's say you get very low CPI. CPI comes in at a nice clip down, let's say 0.3 lower than it should be, and the Fed goes 50 and signals that maybe there's another 25 and they're done. I don't know that there's anything that would stop a rally into the end of the year that could get to 4,300. It could get to 4,300, but valuation, I think, would really start to weigh once you get to, from 18, once you get to 19 times, which this is fairly close to 19. I think at that point you'd have to short that market, with conviction. I had a short position on SPY last week, and with the action, the sell-offs last week, with this kind of negativity last week, I did close my short position on SPY because there is an upcoming dividend next week. I think on SPY it goes ex-dividend, and I didn't want to pay it. I knew I had to close my short position before then because I didn't want to pay it out. So it gave me the opportunity to close my short position 392.99, which is roughly about $10 lower than where I had my short position. Last week I also said that I was short the June ES. I did close my short positions on June because it was such a nice move. Closed it at 4,000. That kind of made my month for me. If nothing else happens, that was just a beautiful move. I am still net short Delta on December 16th expiration. So I got a whole bunch of puts and calls, with more calls short than puts short, expiring this Friday, so that I'm net short or net negative Delta on that. I'm not touching that unless the market gives me, on Monday, unless the market gives me a firm move in one direction or another. I might take some position off, but I'm probably not going to touch this until Thursday or Friday. I don't have to close them out till Friday. I'm probably not going to do anything until then because I don't mind being net short. If the market's going down, great. If the market's going up, all my other positions will go up as well. So I'm not too concerned about that. Look at IVP. Last week, 13-week IVP was 0. We're at 23% now. So here's implied volatility down here in the bottom corner. You can see that it has gone up with this sell-off. It would be nice to see implied volatility get a little bit higher, meaning the index is going a little bit lower. I think for just the health of the market overall, I think it would be prudent not to rally to 4,300 by the end of the year, because you're only going to give it back. And I think that a lower volatility environment would just be better for money being committed to the market. I'd be more willing to commit more funds to the market if volatility remained low. 26 gone from 5 to 31, and 52 18 to 40. Although 52 is not important as the shorter term. With volatility so high, it's really more the recent volatility that matters the most. But 0 to 23. At least we're not sitting on the zero line anymore. So, a little bit more, you get back up to 50%, 60% on the 13 weeks. Suddenly, the premium and the puts becomes interesting all over again. So here we are. How are we going to finish the year is really going to be dictated by this week. And hopefully this equity uncertainty can be solved, because every time I think about, well, how should I position myself? I think, well, every time I do a decision tree, I get to 2 different outcomes. And I have no weighting on probabilities of each, because I don't know what CPI is going to be. Nobody knows, although we have seen wage inflation come in hotter than expected. We did see PPI come in hotter than expected. But none of those things, give us too much insight into what CPI will be. Big question mark. Let's have a look at the week ahead calendar. Okay, what do you think is coming up this week? I wonder if there's anything interesting. Let's look at Monday. You have Bank of Canada Governor speaking at 3:40. We don't speak at 2 o'clock or 2:30. That's just too simple. We like speaking at like 2:40 or 3:26. Really. Anyways, there it is, 3:40. Last week, the Bank of Canada raised rates 50 basis points, and in their statement, they said, we're thinking about stopping. Not that they're going to stop, but they're thinking about stopping. Whereas in the U.S., they say, we're thinking about slowing down. So the difference between that increased the perceived interest rate differential going forward. The Canadian lost value. And so last week I decided to remove my active position on the Canadian dollar. Enough is enough. It's just not going to work out. So why continue on? When I say I remove my active position, I still have a passive position. I have US dollar exposure because I'm exposed to some US stocks. So I hedge it out with futures contracts. My hedge position is very close to my US dollar position. So if the US dollar weakens, my Canadian futures strengthen. If the US dollar strengthens, my Canadian futures weaken, meaning they offset each other. I had an active position, an overhedge, which means that I was betting on Canadian strength. Yeah, I've given up on that. It's, you can only do something for a certain amount of time, and if the Bank of Canada is not going to help you out, you got to stop. And by saying that they're thinking of stopping soon, well, okay, good enough. So that's what's going on in Canada on Monday. Tuesday, there it is right there. In fact, I don't even think that that Monday is going to be an exciting day. I think it's more than likely going to be a sideways day on low volume, or if there is movement, it's going to be on very low volume. They'll be positioning ahead of this. I'm going to watch that 1 month rate just to see if more money is flowing into the 1 month and 2 month, because that's rather interesting. And if it is, it's probably positioning in front of this. This is it. This is the the band before the band, and they're both headliner bands. So don't miss this one. This will move the currency. It will move the Fed funds futures market. It will move the Treasury market. It will move the VIX. It will move this will move everything. So this is going to be a big thing, and I think it's going to be the only thing that matters up until Monday's just going to be meaningless. And then Wednesday, you have the FOMC meeting, and we get the summary of economic projections. So Wednesday's going to be, a big day. You've got three things going on. You got the decision from the Fed, number one. You got the summary of economic projections with the dot plot, number two. And then you have the press conference, which, you think, well, that's the same thing as a Fed decision. Not with Powell. There's unknowns in the press conference. So there's the third thing that's going on at the same time. And there's your press conference down here. Next day you have retail sales. Checking out the strength of the consumer. The expectation here, this is for November, the expectation is for negative 0.2. So that might do something. I don't know what. It depends, right? You get hot CPI and a very hawkish Fed. I don't think retail sales are going to save the day. But if you get a benign CPI report and a kind of a dovish tilt on the Fed with strong retail sales, there's your year. Long and strong until January 31st. There is your year right there. And I don't know. Philly Fed, again, I don't know that this is going to be anything significant in behind the performances we have on Tuesday and Wednesday. And as we go into the end of the week, there's really nothing that can save the week or break the week. Depending on what happens on these 2 days, there's nothing into the end of the week. So if it looks like it was a weak CPI report and the Fed kind of demurs against that, just go long. Just go long the market, and I think you could be long the market into the end of the year, or take your long positions on things that you want, or lean into beta. At that point, I think would be a wise decision. And if not, then, well, there I don't know. I mean, that's where I am right now with equity, is just I'm uncertain, which is why Monday I'll be selling calls on some positions that are high risk on mining stocks, because that's going to be DXY dependent, and on the home builders, because that's going to be interest rate dependent. And then sit tight. I'm going to keep my net negative delta position on SPY with the calls, and then I wait, and then pick up the bodies after. Anyways, we'll see you on Wednesday for the Q&A video, which I'll do early in the morning to get out of the way, because the band starts showing up at noon, and the caterer is here for the Fed party on Wednesday.